Hi, everyone. Welcome to our investor education series. I'm Kat Delgadillo here to co-host our event with our CEO, Hall Martin. Hall Martin is going to go ahead and talk a little bit about what we do here at 10 Capital Network. Hall?
Great. Thanks, Kat. I want to thank everybody for joining us today. We have another great round of presenters. We also have with us today Harshal Shah of Venture Build. We'll talk about his company and what he's doing in this space. And then we'll follow up with a short presentation on term sheets and deal terms for those who are new to angel investing. With that, let's go ahead and kick into what is 10 Capital all about. At heart, we help startups and investors connect for funding. We want to welcome you to today's virtual event. Next slide. And what we do is we help companies get ready for fundraising. We coach on strategy. We get the deck ready. We now provide due diligence reports, which can be very helpful in communicating the value of a deal to an investor. We do a very event-oriented program, both in-person events, online, and dinner events, as well as custom events that we do. In short, we provide the legwork and save you time and money in finding investors for your deal. Next slide. We also help form capital for the early stage ecosystem. We help high net worth individuals start family offices. They fund emerging managers, which is a critical piece of the value chain there. We also help VC funds find limited partners, mostly from family offices. And finally, we also help angel groups find members. And so at heart, we're trying to get more people involved in the early stage ecosystem to fund innovative startups. Next slide. We have this event today. It's the investor education session, and we also have three other online events we do each month. We do the Family Office Roundtable. It's a 2-hour session targeted to those who are starting a family office or those who are running a family office and showing how to improve the process. Post-pandemic, many family offices are moving to the virtual office approach, and instead of having full-time people, they now move to fractional people. Instead of having a physical office, they're doing things online, remote, and distributed. And there's many software tools out there that can facilitate that. So we have reviews of those tools, as well as best practices from those in our network about how to start and run a family office. We also have the quick pitch. It's for tech companies, and basically each company gets 10 minutes to pitch, 5-minute Q&A on a panel just like the one we have here today, but it's focused primarily on pitching. And third, we have the Life Science Syndicate, same thing as the quick pitch, but for life science companies. We run all of these we do once a month, so we do 4 a month. The investor education session plus these 3 you see here. If you want to learn more about our events, just go to 10capital.group and click on the events button. It'll take you to the page showing what events we have coming up. Next slide. If you're a startup and you're interested in raising funding, take a picture of that QR code on the screen there, and we'll follow up to see if the program is a good fit for you, and if it's a match, love to have you in our program as well. At the end of today's session, we will move into a breakout room, and be glad to talk to any startups in the room that are interested in learning more about 10 Capital. Next slide. We also have a podcast program called Investor Connect. We've done over 800 interviews with angels, VCs, and family offices about what they invest, how they invest, and what they look for in startups. And so we have taken all of those programs that we put together and put it in a chat bot called Ava. And we also do what's called a Startup Funding Espresso, which is a 300-word micro blog post, each on an individual topic. And we've taken those and have put them into the Ava chatbot. So all you have to do is ask a question, and it will just give you the answer by scanning over 2,000 of those Startup Funding Espressos we've done since we started. Let's hear more about it.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. So, want to talk about our today's agenda. We're going to have companies pitch. They each get 10 minutes to pitch, 5 minutes of Q&A. Welcome questions from the audience, and Harshal and I will be here on the panel to ask questions as well. Then we're going to have a fireside chat with Harshal Shah of the Venture Build, talk more about his company and what he's doing in the startup ecosystem. We'll then have a short presentation on due diligence and leading the deal for those who are new to investing, and then we will have breakout rooms thereafter. So I want to thank you guys for coming in today. We have our first company coming in, Ken Mariash of Synaptica. Once he gets up here, we'll kick off with his presentation. If you look at the chat box, you can post your questions in there, and there's also a Q&A section that we have to post questions, and I'll read those questions out as well. With that, let's bring up our first presenter. We have Ken Mariash of Synaptica. Ken, let's go ahead and have your presentation go first, and we'll kick off there. Did you have any questions for me, Ken?
No, we're good. So I can go through this pretty fast. Appreciate the time and ability to share this amazing breakthrough with your audience. I'm the CEO. I've been on board for about 2 years, and we've got a personalized take on brain stimulation. It's using an established safe technology, which is called TMS, which some people are familiar with, and we're pairing it with EEG, which most people are also familiar with. The combination is changing everything because now we can confirm we're hitting the right targets in the brain, specifically those memory networks that are affected by Alzheimer's. And so we're about to share with you 2 phase 2 clinical trials that are done, which were completely successful on every measure. And when was the last time you heard that about an Alzheimer's therapy? We're backed by Sony and Time Zero Capital and about 40 other investors into the current round. So all of us know someone who's experienced this hideous disease. I wish we didn't. It really engulfs the lives of families in a way no other terminal disease does. 7 years potentially of just a slow motion train wreck as you become a 24/7 caregiver to these patients. It's absolutely awful. And I watched as my uncle took care of our grandmother as she passed away from Alzheimer's over an agonizing 5-year period. So you might say, yeah, but Alzheimer's is a graveyard of failures, right? Well, the problem is the industry has been obsessively focused for 20 years on one target, one usual suspect, I call it, amyloid. Well, cleaning up amyloid is cleaning up the ashes after the house is burned down. We need to come at this from other directions. We need to look upstream at other so-called suspects. So we're using neuroplasticity as our mode of action. That is electrical stimulation of neurons to induce and strengthen the connections in the memory networks of the brain. So nobody debates whether or not electrical stimulation strengthens neurons. It does. That's what neuroplasticity is. It's like stimulating muscle, grows muscle. The question is, can we get enough neuroplasticity throughout the networks that drive human memory and slow down this disease? So we've paired TMS with EEG, as I said. So TMS was established in 2008. It does work in depression, but really until now it's been shooting in the dark. TMS, you don't really know what you're stimulating. You can use anatomical landmarks on the brain, but it may not surprise you that every brain responds differently to stimulation. So our patented technology combines TMS with EEG so we can see what we're stimulating. And that's literally what you're seeing here is one single pulse to the back of the head. In our case, the precuneus is our target. And you're looking at how that reverberates around the brain, and every patient responds differently. Anyway, it allows us to confirm that we've hit the right target. In our case, the target is the default mode network. That is the network where episodic memory is formed. That is, memories from everyday activities and episodes in your life are really encoded in the default mode network. And Alzheimer's is a disease of memory, so it makes sense to stimulate this network. Anyway, TMS EEG allows us to confirm that we've hit the network. Giacomo is a professor at the University of Ferrara. He's a co-inventor with Emiliano, who's over at Harvard. And these guys came up with this idea of stimulating the DMN and using TMS EEG. They're inventors on the patent there. They're supported by all the right foundations, including by the ADDF, which is Bill Gates' preferred investment vehicle for Alzheimer's. And they're published in all the right journals, over 700 peer-reviewed articles, including prestigious review articles between them. So they're established experts in non-invasive brainstem. We have results from our first phase 2. This is a 6-month study in 50 mild to moderate patients. And what it showed is dramatic ability to slow the disease of Alzheimer's across the board. So this is the primary endpoint. That's the clinical dementia rating, the sum of boxes. That's the way it's usually tallied. This is the FDA's preferred measure of dementia, which they require for drug approvals these days. Well, we hit that endpoint with flying colors. We slowed down the disease by 82%. We also showed significance in other domains of memory and functionality. These patients here, the stimulated arm on measures of activities of daily living, did not lose any function whatsoever. Now, we also changed the brain. We're not just giving patients a temporary boost. We show fMRI data that shows we rewire the brain, creating new connections in the brain. We preserve the microstructure of the brain. We even preserve the gray matter of the brain by slowing the rate of atrophy in the stimulated arm. Now we've done it again. 52-week phase 2 study. By the way, this publication should drop this week. We'll be issuing a press release, but here's the data. Giacomo presented it at the prestigious CTAD conference, which is the biggest Alzheimer's conference in the world. That was the audience in attendance, and you could hear a pin drop because nobody has seen data like this in 20 years, if ever. We were completely successful on every measure. So again, the primary endpoint, we were able to slow down the disease by statistically significant margins, cognition and function and behavior, the trifecta. No drug has ever been able to slow the disease of Alzheimer's in all 3 of these domains. You're probably not familiar, but behavioral disturbances in Alzheimer's are some of the worst aspects of the disease. This is agitation, aggression, hallucinations, depression. On these endpoints, we now also show that our therapy has a beneficial effect. So that's the trifecta. And the worst thing that could happen to you with our therapy is a mild headache which spontaneously resolves. The drugs, by the way, can kill you. They cause brain hemorrhage, they cause brain bleeding, and they have led to deaths in the active arms, and there will be more deaths with the drugs. Here, we're talking about a mild headache that spontaneously resolves. So we got FDA breakthrough designation. We're published in prestigious journals, getting great press, including, I hope, this week with the 12-month data coming out. And the ADDF, that's Bill Gates' preferred vehicle, as I said, came to us when they saw this 12-month data and requested that they would be able to invest into our next clinical study. We're also being highlighted by North America's 5th largest bank, RBC, because they see an enormous IPO potential here. So the therapy is a weekly 20-minute painless therapy. Lay back in a recliner. You can talk to the technician, keep your eyes open if you like, and that's all you need. You just a finger prick blood test and an MRI, 20 minutes once a week, small price to pay for the preservation of everything that it means to be human and all your precious memories, not to mention a life-saving therapy. So we got our patent granted on the method of using TMS EEG to personalize. We did our FTO and it's clean. We own this IP worldwide. And we just got reimbursement codes a few weeks ago specific to our therapy. So no one else can bill these reimbursement codes and they could pay up to $22,000 per patient. Do the math on $22,000 per patient times 6 million patients. You have a very big number with a lot of zeros behind it. That's the kind of opportunity this is. So we'll sell the device and charge per use up to $290,000 per system to Synaptica per year from just 40 patients. And there are 4.8 million on label. And our neurology customers stand to make, again, $22,000 per system per year, $366 per week, over 50 weeks times 40 patients. Gives you a net profit of about $400,000 just from one system. And some of these accounts will have multiple systems in their sites. So we have a thoughtful go-to-market plan, which puts us on a conservative path to $900 million in sales by year 7. The $700 million that you see here is recurring revenue with drug-like margins. And in the hands of a Boston Scientific, They could probably generate somewhere around 2.2 billion by year 7. And how do I know what Boston Scientific could do? Well, I was the head of strategy for their billion-dollar neuromodulation division for about a decade. And so my group did all the financial modeling on all the acquisitions we ever did, including internal launches. I've also sold capital equipment for the Cosman franchise there in 40 countries. We've got some of the biggest names in Alzheimer's on our SAB. They agree this could be a huge breakthrough. And we've got some great commercial advisors too, including the guy who built the market for TMS for depression. So the convertible note that we're offering today funds a phase 2 study, which is already rolling. It's got about 7 patients in it out of 60, still rolling. And if we're successful, it'll double the LTV per patient, which means patients will be on therapy twice as long because they'll initiate in earliest phases of Alzheimer's. That'll be followed by a pivotal study funded by a Series A in up to 15 sites, up to 300 patients, putting us on the market by 2029. However, recent conversations with the FDA, and we have this in writing now, say that they're open to an interim endpoint of 6 months of data, not 12, 6 months of data. That would put us on the market by 2028. My God, that's fast. That's 3 years from now. We could be on the market. And when we're on the market, Boston Scientific could swoop in and buy us. These are just the neuromod deals that they've done, including they bought Axonics for 3.7 billion just last year. And Medtronic also has a very big neuromod portfolio. Abbott, LivaNova, Philips makes sense. GE Healthcare makes total sense as acquirers. And if we don't get acquired, we could IPO. So NovoCure makes a neuromodulation device for glioblastoma. They IPO'd for 1.8 billion. Now Alzheimer's is 400 times bigger market than glioblastoma, and yet they IPO'd for 1.8 billion. So it's not hard to see the enormous returns here with some of these comps. So there's about 1.4 million left. I have to change this slide every day because the money's coming in every single day. We're in process on several more investments now. We've got about 1.4 million left, 40 investors in, 25K minimum for individuals, 250 for institutions. Again, joining Sony and Time Zero Capital. We've just about wrapped this up, folks, and we're just trying to close the rest of this in the next month. So look, this is an exciting breakthrough, holy grail of medicine, phenomenal results from 2 phase 2 studies, a patented moneymaker for neurologists, margins north of 90%, could be on the market by 2028. Oh, and by the way, we have memory enhancement data that shows this works in healthy individuals too. So if you'd like to join us, we have just a little bit of this note left. Please come back with questions and we'll get you aboard. It's painless and easy to get aboard. Takes about 10 minutes of paperwork. With that, I'll turn it over for questions.
Great, Ken. Great presentation. Thank you for that. For those in the audience, if you have a question, please put it in the chat box or the Q&A. Harshal, what would be your first question?
Yep, this is awesome, Ken. I enjoyed the overall presentation. So when you're talking about Alzheimer's, can you also look at some of the other complementary disease types that could have impact on this, or this would just be focused on Alzheimer's?
Great question. Thank you for the question. Indeed, this is a platform technology for personalized brain stimulation in many indications. We have data in stroke. We have data in Parkinson's, memory enhancement you just saw. TBI would be interesting as well. Others have generated good data in TBI. So the neurodegenerative space makes sense because you're inducing neuroplasticity. So those are the preferred indications. We could also go into neuropsychiatric indications like depression, anxiety, OCD, addiction maybe. Those are tougher indications because it's more competitive, but our platform technology could be used in any of these, and we do have some data in quite a few of them. We're laser focused on Alzheimer's. I don't want to be, distracted by other indications, but you can imagine we could out-license these indications to others. Yep.
That was the whole idea. Thanks, Ken.
Sure. So you had some good exits up there, or exit opportunities, Ken. Can you talk about the one that is the most likely and why would they buy you?
Yeah. Well, I mean, I'm a little bit partial to Boston Scientific because those are my people. And we looked at when I was at Boston, we looked at all these deals and we did make an investment, we being Boston Scientific, we made an investment in Functional, which is DBS for Alzheimer's. So I know that Boston is already interested in Alzheimer's. And so I've had multiple conversations at the highest level with Boston Scientific. I've been invited to their offices twice now to meet with their division president, Jim Cassidy, who oversees this billion-dollar division. It's a good fit for them because they already have a bit of the neuromodulation. Well, they specialize in neuromodulation. They have a bit of the neurology call point. They're already focused on DBS for Parkinson's, which is treated by a neurologist. Now, it's a particular flavor of neurologist. It's a movement disorder neurologist. But in those offices where they have multiple specialties, they could have a neurologist treating epilepsy, a neurologist treating Parkinson's, and then also a neurologist treating Alzheimer's. That's an ideal account. And so the pull through, the synergy from that footprint would be tremendous. So I think it's a perfect fit for them. Obviously, I'm partial. The others make sense as well. But of course, I'd love to come home to Boston one day.
Great. Can you talk more about the business case, in particular the subscription model and the unit economics story you have there?
Yeah, it's really good economics. So let's go back to this. So if the codes pay about 366 on average, so let's unpack that. We just got reimbursement codes that cover the calibration step, which I forgot to mention occurs every 3 months. We're going to recalibrate. That pays about $1,000 in the estimate of our reimbursement consultant. By the way, I'm talking to CMS. Medicare later today about APC assignments for pricing these codes, but we have the codes. And so that code that does calibration could pay about $1,000 4 times a year. And then the treatment code might pay about $300 per week. And so you add that up over 50 weeks, it's about $22,000 per year. And by the way, one other aspect of the therapy too is that we do an induction phase. I forgot to mention that. We do 10 days of daily stimulation initially just to kickstart the brain. So you're billing $300 every day for 10 days to kickstart. So you get a little bit of a jump on reimbursement. So the unit economics are really good for a neurologist. This system will pay for itself in under a year. That's really fast payback if this is the case. Now, we're estimating 40 patients is the capacity. That means 1 patient per hour in a 40-hour week. It could easily be 50 or 60 if the account stayed open till 6 p.m. or 7 p.m. or open on weekends. Some of the market research respondents that we talked to said that they have a line out the door on day 1. But we've been very conservative. We've not assumed that. So we've assumed a very conservative 40 patients capacity. And so I think we're being pretty reasonable there with the unit economics, but they are fabulous economics. I'm not joking with this quote. They will send a car and driver to pick these patients up.
Great. Thanks, Kim, for a great presentation. We're at the 15 minutes, as you hear by the sound there, but appreciate you sharing that with us today. Kim will be in the breakout rooms for those afterwards who want to catch up with him. And we'll move now to our next presenter, Enamel Pure. Nathan, go ahead and launch your slides and kick off when ready.
Hi, Nathan Monti, co-founder and CEO of Enamel Pure. So Enamel Pure is attacking the preventive dentistry market, which is your hygienist and your teeth cleaning visits. We're combining a laser and imaging technology on a med device that updates the 50-year-old technology that the present-day hygienists are using. Surprisingly, Americans spend $22 billion a year, not projected. That's cash spent a year on teeth cleanings, fluorides, whitenings, and clear aligners. $16 billion is spent on teeth cleanings and fluoride treatments alone. Worldwide, the market's about $50 billion. So this is Loon, our device. The laser's inside and the camera's bolted onto the beam delivery at the last knuckle. The laser's used to clean teeth. It's used to harden teeth to replace the inner office fluoride. And then we have a whitening mouth guard, which the patient drives home in their mouth to save time for the dentist. And the camera's bolted onto the beam delivery such that the camera and the laser are collinear coming out of the handpiece. So the hygienist simply waves the handpiece over the patient's mouth. When doing that, the teeth are cleaned or the enamel is hardened, and simultaneously the camera is flashing to take a 3D image of the teeth and the gums during the same procedure. Again, everything's geared towards making the dental visit quick and easy. Device costs about $35,000. It's $750 or $800 a month, which is very affordable. Everybody knows about this slide. It's going to your hygienist, noisy, a lot of rinsing, bleeding, a lot of pain. And the diagnostics is all done manually. The hygienist or the dentist just looks at your teeth and gums and makes an assessment based on their skill level. So what are we doing? Laser cleaning, it's twice as fast. So a 50 or 60-minute appointment is 30 minutes going forward. It's very quiet. It's non-contact. You don't have any pain. There's very little sensation, but there is a little bit of odor. The clinical advantages are the plaque is completely removed for the first time ever, and it kills all the bacteria for the first time ever. The laser purification, which is our marketing phrase for hardening of the enamel, it's 10 times harder than using the fluoride varnishes that the dental offices presently use. And that increases the acid resistance of your teeth, your enamel, so your teeth stay thicker and whiter for life. And then the whitening mouth guard, you pop it in after the cleaning and or the purification, and the patient drives home with a mouth guard in their mouth because there's a battery inside that drives it for about an hour while the whitening happens. And then the camera is used for taking a 3D digital impression. Both color, I mean, it's in color and it's 2D and 3D, and the digital impression can be converted to a measurement file, which can then be downloaded for clear aligner manufacturing. So why do the imaging during the teeth cleaning? Simply because we're trying to create the most robust image data set ever in dentistry. 160 million Americans sit in the chair to have their teeth cleaned every year. And during those cleanings, we can get a 3D digital image of their teeth and gums such that we can lead to longitudinal analysis, diagnostic analysis of their oral health. So what is that? What is oral health? Well, it could be, are your gums receding too fast? Or is your enamel eroding too fast? Do you have bruxism? Are you nighttime grinding? And do you have acid reflux in your mouth? So all of these things can be monitored each visit. So longitudinally, you come in once, twice, 3 times, and then the AI automatically compares the imaging from one visit to the next to create what we call an AI oral health report each year that you go. And there's a lot of AI out there right now. AI is perfect for dentistry because all of the diagnostics in dentistry is done by what you see. So how your gums appear, how your teeth appear, that's how the diagnostics are done. And the computerized AI, as long as you have enough data, automates that. It makes it a lot more user-friendly. It also makes it a lot more precise in the diagnostic capability. So our product roadmap, we've finished up the clinical situation, the clinical cleanings and hardenings. Then this year and next year, we're starting to do the camera and the AI. So we'll be introducing the camera and AI in the annual oral health report at the end of 2026. And then after that, we'll use the same oral health data to reconcile that with people's medical data so we can link any sort of like bacterial decay in the mouth to heart disease or brain disease. Again, there's a lot of theorized links there. And so we've patented the idea of actually taking our data set and looking to see what's, if there is a link. So dentistry. So we have a very much a need. People need to go get their teeth cleaned a couple times a year. It's not a great technology. A lot of people don't like the dentist. One of the top 3 fears in America is going to the eye dentist and the dentist. The technology is extremely old. So we have a very neat new technology to address the need and the anxiety of the patient. So how do we sell it? How do we get to market? So dentistry is old school. 95% of the dental offices, there's 200 to 205 dental offices in America. 95% of those are serviced by 3 major sales distributors. So we have an agreement both with Henry Schein and Benco to address all those dental offices. We also have an agreement with Medicine Partners. The Medicine Partners agreement is to do a lot of the social marketing the TikToks and the Instagrams of the world. So they're helping us to launch on the in social media as we go forward. We do all the sales and service support in-house. We don't have anybody in the field, and the manufacturing is done at a contract manufacturer, so we don't have to hire manufacturing staff. Once the unit's built and tested per our procedures, it ships directly to the dental office. So next two slides are just to explain how we fit into the industry. We make the device. We make the laser device and the imaging device. We package it together. We create the measurement file for the clear aligners. We have our own regulatory and IP support in-house. And that's where everything blue on the left-hand side of the screen, that's where our involvement ends. The sales are done by our partners. Any longitudinal clinical studies are done by our partners. The AI software is done by our partner. The clear aligner manufacturing is done by our partner. That way, we can set up a very profitable revenue stream, but also penetrate the market as quickly as possible. And how does it actually fit in the dental office? Well, its loom is about a foot square, and it rolls right up next to the dental chair. And the hygienist swings the beam delivery and waves the dental handpiece about a quarter inch away from the patient's teeth, and all of the plaque is vaporized and the bacteria is killed. At the same time, the computer inside links to the practice management system inside the dental office. And so in that way, we never needed any HIPAA requirements. We just get the patient's number from the practice management system, attach it to our data and upload it. The actual interaction with the patient and the dentist, as well as getting the AI processing, that's all done by the practice management software companies. Again, it's just to make sure we can just roll our device in, fit directly in the dental office, and be off and running as quickly as possible. Again, the contract manufacturer ships directly to the dental office. My business partner is a patent lawyer. We have 23 patents filed, 9 are issued at this point, and we're working on 6 more as we build out the camera and the AI over the next 18 months. How do we make money? We have a revenue model where we sell the capital equipment at 50% margin. We charge $2 per teeth cleaning. There's 160 million a year. We charge $3 for a laser hardening. And we also charge for our whitening mouth guard, the AI diagnostics and measurement. That's data that we license. And when we upload the data, we charge as well. So I'm Nathan Monti. I founded a company called Light Laser for Industrial Marking. We sold that to Danaher Corporation, Videojet Technologies. I also founded a company called Convergent Dental, which uses a laser for drilling cavities. That's in Waltham, Mass. They're nearly 30 million in sales, and hopefully we'll exit from that. My business partner, Chuck, he's a patent lawyer, like I said. Before that, he was an engineer working with laser and imaging in the med device field, primarily skin resurfacing. Now, a patent slide, I'll skip that. You can look at it later if you will. So where are we? We were FDA cleared last March. The pilot manufacturing is going on now. We will have units ready to ship next week and the week after to key opinion leaders in the New England area, and then the product manufacturing will start in June. So there's a super seed round still open with 250,000 left at 8 million pre. And then I'll start a Series A as the manufacturing production starts up, where I'll raise 8 million at about a $32 million pre. So thank you very much for your time and listening. And if you have any questions, just let me know.
Great. Thanks, Nathan. Harshal, what's your first question?
Nathan, I have 2 questions and glad to again meet you. The first one is, I assume that I mean, essentially right now when you're doing this, do you already have some data for the AI calculation, or is that something that you start getting in as you start reaching out to market, right? That's my first question. And the second question that I had was, you said you do partnership with a lot of guys, including aligners and stuff like that. As part of your identifying the monetization strategies, would you also rather take into a percentage rev share with some of these guys that you partner with?
Oh, well, thanks very much for the question. So the first question, there's a tremendous amount of data available online for the machine learning side of the AI. There are a lot of digital scans that are done presently with the different devices. The issue with those scans is, first of all, people won't come in and sit in the dental office to have their teeth scanned. And if you ask them to do the scan at the end of their cleaning, they almost all say no. So the
Yes.
idea is to get the scan while they're in the chair. The other issue with the scanning is, for the FDA, in order to get your AI cleared, you have to have consistent, repeatable results with the same camera. And so that's why we use the same camera, and then we leverage the online data, which is available for our AI. That's how that works. The other question is, initially, we'll be using a traditional distribution network arrangement where we pay a commission on the sale of the device, but we're also piggybacking that with a percentage of the recurring revenue going to the salesperson. Again, when we use a distributor or we use a contract manufacturer, it's very cash efficient. We don't have to hire a whole lot of people, but how do you get the salespeople motivated to sell your product within their whole portfolio? So if we're charging $2 per teeth cleaning, we're talking about anybody that sells the device in the first 12 months will get 25 cents per teeth cleaning from that $2. And again, that's to motivate the sales force as well as the distributor and get them out in the field and get them selling our devices.
Well, thanks, Nathan.
Thank you.
Great. My question, Nathan, is can you talk about your history in starting and running and exiting startup businesses?
Yeah, sure. So I started doing my first startup back in in my early 40s, right? So we started Light Laser 20 years ago. Wow. So at Light Laser, we ended up exiting that, selling it to Videojet Technologies. That was for marking like water bottles or Coke bottles, plastic bottles, to eliminate the ink. Those plastic bottles go about 60 miles an hour, so the ink wasn't fast enough, and the laser was. And then I started Convergent Dental, where we built the Solea laser, and that's used for drilling cavities, and they've sold over 2,000 at this point. Like I said, they're almost up to 30 million haul, and they're hoping to break 35 million next year, and then they would exit either by M&A or floating the company. So, and then in 2022, almost 3 years ago, Chuck and I started Enamel Pure, and in the 3 years we've got the product developed, the FDA clearance, and the manufacturing started, and we'll start our pre-sale shipments in June.
Great. Thank you. That's our 15 minutes. Appreciate the presentation. With that, we'll move to our third and final presenter, Lance, Print3D. Lance, go and kick off your slides whenever you're ready. You're on mute, Lance.
There we go. That's better. Hi, I'm Lance Thurlkill, co-founder of Printed Technologies. And as you can see here from this slide, America has a real problem. We are short 7.3 million affordable homes. And we're only building 1.4 million homes per year, of which less than 10% are focused on affordable housing. Further, construction costs are up 30% in 5 years. And the industry is stuck in the past, and people are struggling to afford a place to live. At Printed Technologies, we are solving this problem by disrupting the construction industry. And we're doing that by bringing automation, AI, and 3D printing to construction to make it more affordable, sustainable, and scalable. But before I tell you how we can do that, let me tell you how we got here today. In 2021, my family unexpectedly lost their home to mold. We had to move out overnight. And after remediating, the next build that we did took twice as long and went 50% over budget. And I thought there had to be a better way. And if it's this expensive and inefficient for me, how much more impactful is that for people who are struggling to afford a place to live in the first place? The reality is the system is broken. And when there's a broken system, there's an opportunity for innovation. And that's why we built Printed Technologies, to solve a real market failure. Here's a picture with my founding partner, Craig Pettit, and myself outside of one of our 3D printed homes. My family has been invested with Craig in his residential real estate portfolio company for over 30 years. And in 2019, he bought his first 3D printing machine and printed the 7th and 8th 3D printed homes in America. As a third generation owner of a manufacturing company that is highly focused on automation, I became fascinated with this concept. And through my experiences building several homes, the frustrations and with the inefficiencies in that industry were just shocking to me. Coming from manufacturing where precision and efficiency are everything, I was shocked by the lack of these principles in construction. That frustration sparked an idea. What if we can apply a manufacturing mindset, AI, robotics, and automation to disrupt the construction industry? I shared my vision with Craig, and he immediately saw the potential, and we had the perfect combination of expertise. His real estate background, my manufacturing experience, to tackle one of the largest problems in the world, affordable housing. So in 2023, we made our move. My company, All Metals Fabricating, invested $750,000 to match Craig's investment today, and we launched Printed Technologies. Our mission is simple: revolutionize construction to make it more affordable, efficient, and sustainable. We're not just building homes, we're manufacturing and selling the machines that will help builders embrace this new era of construction. So let's talk about how we got here. The American dream. It was for over a century, 100 years, America has built homes the same way: wood framing, labor-intensive construction. And it worked. It fueled expansion, supported growing families, created communities. But the reality is the American dream has slipped away due to rising costs caused by skilled labor shortages and rising material costs, compounded by the industry's slow adoption to new technologies. As you can see from this graph here, rents have been rising drastically more than incomes for over a decade. Further, average home prices are up more than 100% just since 2000, while wages have not kept up. Construction costs are up 30% in the last 5 years, and not including the surges we are about to see from the tariffs. So the industry has been forced to use less skilled workers and inferior materials to lower costs, which leads to a decline in the quality of housing. In just 10 years, the affordability, the amount of people being able to afford a home has dropped from 50% down to 16%. This is a massive issue. But we have a solution. I'm sure a lot of you have seen a little desktop 3D printer before. We'll scale that up to the size of a house, and that's what you can see here, our patented 3D printing machine. It works like a soft serve ice cream dispenser in that it's dispensing concrete instead. And the G code, the geometric code, tells the print head where to go to print the wall structure for the house. So what differences does our solution offer? We can provide a 20% savings for a wall system that far outperforms traditional building methods. And our houses are termite resistant, fire resistant, hurricane resistant, and tornado resistant. You know, I'll reference the fires in California recently. There's one house left standing in Malibu, and that was a concrete house. The same thing was true in Hawaii several years ago. There's one house left standing. It was concrete. Granted, they weren't 3D printed, but it's the same materials and the same application applies in terms of fire resistance. Time is money. We can provide a 30% time savings versus traditional construction. With our wall structures, you remove framing, sheetrock, masonry, paint, and insulation. Next, precision construction practices reduce waste significantly. The combination of proper and precise planning with using recycled materials and the long-term durability of the concrete will significantly reduce landfills over time. Lastly, they reduce ownership costs. So our walls are more energy efficient, resulting in less energy costs, less carbon footprint, and also the walls are much more durable, so less maintenance costs as well for the homeowner. So our competitive advantage starts with our partnership with All Metals Fabricating, which I own. It's a world-class manufacturing facility that's shown here in this picture. It gives us vertical integration, giving us full control over production, cutting costs on our engineering and the printers we sell. Example by our current model cost basis is $175,000. The most comparable one on the market starts at a sales price of $1 million. Even more importantly, through this partnership, we can scale up production to meet any demand that the market creates for 3D printers. We have no capacity constraint with All Metals partnership. Next, combining our real estate experience with data-driven insights and approach will allow us to streamline construction nationwide. Lastly, Printed has an expertise and an efficiency focus and automated approach through our partnership with All Metals Fabricating. So what have we accomplished? 2019, we started the company. 2021, we successfully printed the 7th and 8th 3D printed homes in America. Since then, we printed 5 other structures, including a house for just over $100,000 this past year. We designed and built 2 of our 2nd generation machines. We achieved a top 10 worldwide rating for automate construction and top 5 for 3D home printing. We developed an augmented reality app that allows consumers to walk through the house, put it on any lot, and walk through the house virtually. We look to grow this application to train builders as well on the machine. We completed a rebranding and launched a marketing campaign last fall. And then 2025, we received our patents back for our design. We've developed $2.5 million in the sales pipeline. We've invested $1.5 million to date, and we just won this recently, the 3D Printing Company of the Year by Construction Tech Review magazine. All of this gives us a great confidence in raising $1 million at a discounted $8 million valuation, and the second tranche at $2 million at a $15 million valuation. What we're going to use the funds for starts with developing our own proprietary software, which will allow you to take architectural renderings, whether they be 2D or 3D, drop them into the software and automatically create the G code to run the machine. This would be huge for builders so that they can take any plans and create their G code automatically, also giving them estimates on the cost of the wall structure. And equally as important, this creates a SaaS revenue stream for us, which as a technology company is very important. Next, we're going to invest in a brick-style print head to appeal to traditional architectural designs, and also that will result in print time as well. We're going to hire an R&D team to support our ongoing innovation so that construction jobs don't limit our ongoing innovation. And we're going to build some additional machines so that we can take on large development projects and also have safety stock to be able to sell machines. Here's what we believe are some very conservative numbers. I personally believe in under-promising and over-delivering to customers and investors. And so this is based on both printing structures and selling machines. So 2025, I believe, is actually the most aggressive number with 9 structures printed and 2 machines sold. 2026, 40 and 8. 2027, 75 and 24. And 2028, 125 and 48 machines. Now, I'll mention that market adoption by builders could exponentially increase this growth curve. And All Metals, as I mentioned earlier, would have no capacity constraints with producing as many systems as the market could demand. So, for example, if we sold 100 printers instead of 48, that would boost our revenue by $20 million and profitability substantially. And I'll remind you that our cost basis on a machine is $175, and we plan on selling them for $400,000, with the closest competitor being at $1 million. So I want you to imagine this with me. I want you to imagine an entire community being built by 3D printers, 20, 30 printers out there. And I want you to imagine a house in a box, what we call a house in a box, showing up for each house with everything you need, the HVAC, the doors, windows, roof, everything, all in a box. So the trades can get in and out of the house as quickly as possible. And I want you to imagine the family like this one moving in 3 months later at an affordable price that they can be excited about. And with this type of solution, combined with everything else out there, we can change the trajectories of affordable housing. This is more than an investment. It's an opportunity to fix a broken system and transform the future of housing and construction. We have the technology, the expertise, and the urgency to make homeownership more accessible while building a high-growth, scalable business. The need is massive. The time is now. Join us. Thank you.
Great job there, Lance. Harshal, what's your first question?
Yep. Lance, first of all, congratulations. I think I'm actually really excited about 3D printed houses, right? And so this is definitely a massive opportunity. I quickly wanted to see, because I have some insights into this. Can you speak about the competitive landscape in this space right now?
Yes, sir. Yeah. So the competitive landscape, we have a slide on this, but I can just speak at a high level to it. On the machine, it's kind of broken up into different sectors. Machine sales, which is Cobot, is the biggest competitor, I'm sure you know. And that's who I referenced, starts out at selling at a $1 million price. A lot of the other people that are in the space that you see 3D home printing have a cobot machine that they've kind of rebranded themselves by putting on some different features on it, specifically around the print head. Icon obviously is the gorilla in the room. They do not sell their equipment, and I don't believe they have any plans to. So you have the two big players, one that's just selling machines, one that's just printing, and us, along with a few others, are the few that actually have our own machines that we plan to sell and that we can print on site. And so, with the biggest differentiator being our vertical integration, and that with All Metals Investment, we have a $25 million manufacturing facility at our disposal.
Wonderful. And are you looking at US as the primary market, Lance, or are you looking at outside the US as well?
So that's a great question. Our numbers are based on the U.S. market, but we're looking worldwide. We're actually talking with a potential lead investor in Australia because the opportunity is so massive there.
Yes.
But we've built our system to be as simple as possible so that it can be used in remote parts of the world. That's our focus, is simplicity. And so that's as you innovate more, that's a delicate line to balance, as I know, as I buy $1 million and $2 million machines all the time for manufacturing. So we want to focus on simplicity, but innovative.
Perfect.
And for that reason.
No, absolutely, Lance. I'll be happy to talk more as well, but this is awesome. Thank you.
Thank you so much, Harshal.
Great. So my question, Lance, is can you talk about the sales pipeline? Give us some color around the type of deals that are coming down. Are they private, commercial, government? What are you seeing there?
Yes, sir. So yeah, let me start by just adding that we'd never had a sales pipeline because we were printing for Craig's residential real estate portfolio up until we just developed our pipeline in December in our process. So and just started our marketing plan in November. So thus far we've bid on several custom jobs that are like one is $1 million house. The other couple are $500,000. We also have a development deal in the pipeline that I wasn't really including in those numbers as well. This is really great for build to rent communities, is a great niche because, I mentioned earlier that the ownership cost, but as an owner that's renting it, we have that experience from Craig's real estate portfolio, and the turnover fee is only about $500 as opposed to, several thousand for tenants in traditional construction. So it's really great for build to rent, and we're just now starting to pursue those opportunities. Actually just got off the phone with one right before.
Great. You have intellectual property filed and coming through. What are the claims that you make? What protection does it give you on your business?
So the design of our machine, our hose management system, especially, has been recognized by multiple people in the industry as the best, and so we've got that patented as well. So basically the design of the machine, the way that it runs, and the hose management are some critical components that are protected.
And great. So what's your ideal project you want to go after? You mentioned you got some good things in the print to build space, but can you be more specific?
Yeah, the print to rent is really ideal for us, and so that's what we're going to be looking to go after, as well as so right now the biggest constraint in the industry is that cities don't know how to inspect the plans, and they don't know how to inspect the print. And so there's a ICC committee that's developing the standards, which once that's adopted, I think that's when the faucet will turn on in terms of people wanting to buy machines and just opportunities to print. So right now we're a little limited to rural areas, but we look to start to work with governmental bodies on the affordable housing front so that that will incentivize them to welcome this new technology because you're helping them solve a real problem that they have.
Great. We're at the end of our time. Thanks for a great presentation, Lance. Thank you, Harshal, for great questions as well. And with that, let's move into our next segment today. We have with us Harshal Shah of the Venture Build, and love to have him come up, and we're going to have a short Q&A. If you have questions, please put it in the chat box. But with that, let me go and kick off and just welcome Harshal here. He's the founder and CEO of the Venture Build, an operator-focused venture capital company. He also serves as CEO of Gateway Digital US and brings over 25 years of executive leadership, business, and technology experience. And additionally, he's the president of Thai Austin, one of the largest nonprofit entrepreneur networks in the world. Harshal, thank you for joining us.
Thanks a lot for having me, Hall.
So let's kick off with Venture Build. What inspired you to establish it, and how does its operator focus venture capital approach differentiate from traditional VC?
Absolutely. Thanks a lot, Hall. Uh, to answer that question, let me go back a little bit and tell you about my background, right? So I used to run P&Ls for healthcare and life sciences, product engineering services, and I ran private equity markets for a billion-dollar technology services company before I started off the venture bit. When I was running the private equity market space, what I figured was the overall private equity marketplace works beautifully because there is an investment arm and there is an operator arm. The moment a private equity would invest into a company, they'll turn that around with an operator ecosystem, which will go ahead and start providing all the fuel that is needed for this company to get to the next level. When I was analyzing the venture-backed companies, I figured that that operator ecosystem was missing in the venture-backed companies, right? So the venture equity guys or the VCs, right, would start putting in funds, right? But as you rightly said, so I mean, I love 10 Capital Network, and I know we've partnered with them. So the way we started looking at it, if you start looking at a scale up, right, there are 2 or 3 major things apart from funding that a scale up would need, right? One is really exec advisory on go-to-market strategy. How do you actually scale from 5 to 50, 50 to 500, right? The second, they would need easy access to early customers. And as all of us know, it does not come out very easy. And the third is you would have to start working in constraints. And so how do you actually start scaling teams while you have the cash constraints, right? So the venture build addresses all of these issues, right? So what we do is we help scale ups with exec advisory focused on GTM strategy and how do you actually do overall go-to-market sales. The second is we have built a reseller and a referral network base, right? So essentially that allows having early access to some of these early customers. And the third is we have a shared services marketplace. So a lot of smaller needs would allow you to start actually doing that at a fractional ecosystem, right? So be it fractional leadership or fractional services, right? So a lot of the shared services can be leveraged, right, using the venture build ecosystem. So that was the whole focus of building venture build.
Well, great. So as CEO of both the Venture Build and Gateway Digital, how do you balance the responsibilities and objectives of those two organizations?
Yeah, it's very tricky, as you rightly captured, Hall, right? But what figured out what so, and the reason why I actually took that gateway position was primarily because if you look at the shared services ecosystem, right, some of these things would become partners, right? So from a product engineering side, Gateway could actually be a product engineering partner to a lot of these scale-ups, right? And that helps me balances out the venture build landscape, right? And really, again, focuses on the same customers that we help, right? Which is the scale ups, right? So how do you actually start working with these companies when they start really getting there, right? So imagine somebody getting infusion of Series A, Series B, right? You would start getting the funds, right? Now you would have to start scaling rapidly. And as all of us know, right, every scale requires huge amount of back and forth, right, to get the right team and balance it out. Right? If you start looking at, if you want to start scaling faster, right, while you're building your team, right, leveraging some of these shared services resources would allow you to start reaching that, right? And that's where Gateway comes in, where part of the core product engineering can actually be done through Gateway, and then you can still continue scaling, helping scale ups as part of it.
Great. Well, with over 25 years in executive leadership across many sectors, what key lessons have you learned about scaling digital businesses effectively?
So it's a very, very interesting question, right? If you start looking at any business, right, and when we start zooming out, right, the fundamentals of the business remains the same, whether they are digital or traditional businesses. It's just that people actually start seeing some of these separately, right? One, it is people, right? Both on your outside as well as inside, both your employees as well as your customers, right? The moment you start understanding and listening to them, you actually start learning a lot more from them, right? Second, I would say persistence. I mean, a lot of these things, right? A lot of scale-ups and a lot of startups. I've been working again with the Thai ecosystem as well, right? I've been working with a lot of startups, right? I mean, one of the key differentiators between a successful entrepreneur and a not so successful entrepreneur, right, is their ability to be able to persist, right? There are ups and downs that are going to come up, right? But if you can continue persisting yourself in that landscape, right, with the right people in the team, that gets you where you want to be, right? So I think there are some very key foundational elements, right, to any businesses, all right? And if you can start focusing on some of that, that definitely helps.
Great. Can you share insights into your role as president of Thai Austin and how this position influences your work with startups and entrepreneurs?
Absolutely, absolutely. Thai is a very interesting organization. Thai is a not-for-profit organization. This has been in existence for more than 30 years. Started off really with the focus where some very established venture capital guys out of Bay Area figured that there has to be some mechanism by which we can start helping budding entrepreneurs work with successful entrepreneurs, gain their overall mentorship, right, without any baggage, and give back, right? That was the whole intent where Thai was born. It's been 30 years. This is one of the largest not-for-profit, as you rightly mentioned, 30,000 members, 58 chapters all across the globe. The primary focus is on 5 fundamental focus areas: mentoring, education, networking, incubation, funding. So the core is, how do you actually start working with budding entrepreneurs, connect them with successful entrepreneurs on all of these 5 core pillars? And this ties very well to what the venture build is doing. As you can imagine, the intent of taking these entrepreneurs, right, from 0 to 1 is very well done through Thai. And then once they reach at a certain scale, the venture build can actually start helping them take it to the next level, right? So it's a very interesting mix. And at the end of it, it allows people to start getting there and making those dreams come to reality.
Well, given your background in healthcare and life sciences, how do you see technology transforming these industries in the coming decade?
That's a very, very interesting question. Healthcare and life sciences, when I started looking at it, because I used to work also on the digital side of the business outside of healthcare. And so when I used to work with the Oracles and IBMs of the world as my product engineering services background, when I first got in healthcare, I was simply amazed. I mean, I think the kind of archaic tools and technologies that healthcare industry was using back then were like crazy. But it's been changing quite a bit. A lot of big enterprises coming in. Of course, a lot of changes in the technology, AI, robotics, and others are adding on to a huge amount of change, more both on technology side and also the attitude side, right? I mean, so a lot of things have actually started adding on more color, right? On earlier, it was only one industry which was focusing on this. Now there are enterprises, there are pharmacies, there are payers, all of them combining each other and trying to figure out how do you keep patients healthy, which should be the core, right? And so I think that's actually helping quite a bit in terms of innovation. What is happening is there is a huge amount of data, as you can imagine, in healthcare, and now with artificial intelligence coming in, all of that data is is getting into a good use, right? We heard Nathan today, right, talking about how he's using AI in dental. Those are some of the things. I was involved in some very, very interesting initiatives where physicians from some of the renowned hospital systems are actually using immense amount of data to start studying chronic conditions in a very, very interesting way to see how you can start making patients healthier even before these chronic conditions get in, right? So there are some very interesting changes that are happening, and I'm actually very, very optimistic about the future of.
Great. Well, the venture build emphasizes assisting companies in connecting with the right investors and experts. What criteria do you use to determine these strategic connections?
So there are very interesting things that generally we start looking at how, right? But one is what stage is the company in, right? And so the stage of the company allows you to start positioning as to how do you start helping them at the right stage with the right pool of investors, right? And it's actually very interesting because when I start looking at different sets of entrepreneurs, a lot of times they have no clue on what stage and what kind of entities from an investor side, right, they would start looking at, right? I mean, there are certain stages where angels would be best. There are certain stages where VCs could actually be better. And there are certain stages where you might actually want to start looking at PEs or getting IPOs. There are certain stages where you might not even want to have external investments, right? So really helping entrepreneurs understand the landscape of where they are and how do you actually start leveraging that to connect to the right set of people is the key thing that the venture build is working with, right? And I'm very glad, right, to partner with somebody like you as well, Hall, where we have been helping some of these companies, right, in terms of really getting them, right, to education sessions like this.
Great. Well, those in the audience, if you have a question to put in the chat box, and we'll call it out here in a few moments. My next question is, as an advisor to multiple startups and a board member of several companies, what common challenges do you observe among early stage companies, and how do you recommend addressing them?
Yeah. Entrepreneurship, Hall, is extremely lonely. Okay. If you are starting to look at either you have your employees or your venture capitalists, right, sitting on you and the customers. Having a trusted advisor to be able to start working and really talking through what is wrong, what is right, and having that guided path is extremely important. And so a lot of times we actually sit with some of these founders, really help them, right, as trusted advisors and allies, right, or get them to that stage where they can open up. I've also actually suggested a lot of these founders to start working and teaming up. So the right kind of founders can actually get together and start creating their own groups, right, to be able to start sharing some of these thought processes and really be helping each other out, because this is, I mean, it's a long journey, and it is a lot of times it's an individual who will start doing that, right? So creating that network and talking to people allows you to start doing a lot of these things. Good part is, I mean, some of these cities that we're seeing now, a lot of these groups have started up. That's actually adding a whole lot of value, and then leveraging a lot of these know-how that people would have all across, and learning from a lot of that would certainly help.
Great. And so, how does your experience with private equity and product engineering services inform your investment strategies at the venture build?
It's a very tricky thing. When I started off working with the private equity ecosystem, to be very frank, I had no idea, right, of how they would start scaling some of these things up. But they have created a very interesting playbook, right, in terms of being able to start working and identifying some of these things and scaling them to increase efficiency. So once you start reaching at a certain stage, being efficient on not only the top line, but the bottom line is very critical, right? And private equity has been doing that in a very meaningful way. They've actually identified all the right ways of adding on more to the bottom line, identifying the right partners, and then connecting those dots in such a way that it becomes a win-win-win strategy for everybody involved. And that has worked extremely well when I started actually looking at the venture world, because as I was explaining earlier, a lot of those know-hows, at least their initial pieces, was missing. This was every company is run in its own way. Can you actually start looking at this holistically and start leveraging the power of efficiencies even for the venture-backed companies? That's one thing that we are doing a whole lot more as part of the venture bit.
Great. My last question is, well, looking ahead, what emerging technologies or market trends do you believe will have the most significant impact on the VC landscape?
You can't end a conversation without an AI conversation hall these days, correct? But I think what I would say is, so the base of AI is already there. I think the applied AI ecosystem, which is going to actually start translating a whole lot more, right, in terms of really creating meaningful use cases on top of AI, right? And that to me is going to start coming up extremely well, right? So there was this whole theory of conceptualize AI to generative AI to agentic AI, right? And then physical AI, right? So if you start looking at it, robotics, digital twin ecosystem, and I was glad to look at the 3D printing landscape that Lance was talking about, right? I mean, digital twin, and I've been involved in the digital twin consortium quite a bit, started looking at the kind of scale that we are building, right, through digital twin ecosystem. Quantum computing, right, is actually scaling up quite well, right? So some of these new areas, right, are going to start changing a huge amount of potential from a data perspective, right? Today, we have crazy amount of data that is generated. But if we start looking at it 5 years down the line, 10 years down the line, imagine this data getting double, triple, quadruple, right, in a matter of months, right? Now when you start looking at automation is going to a completely different scale. And that is going to start translating into some insights which are going to be super powerful. I mean, now it's about how do you start using them, right? So for example, I mean, when we used to do a lot of cancer research way back, right, you would have to define on a lot of actual patient data to be able to start doing that. Using AI, you can start simulating a lot of these things in a much more meaningful way. Now you require a lot of quality, and that is in place, but this will start actually identifying and getting some of these diagnostics happening a whole lot more faster, thanks to a lot of changes that are happening through technology today. So I'm pretty optimistic, actually.
That's great. Well, thank you for a great presentation there, Harshal. Thanks so much for taking time to join us today. I want to thank the audience as well. With that, we'll go to our final segment of the day. We're going to have a short presentation on due diligence and leading the deal. Let me go ahead and share my slides here and we'll walk through it. If you have a question in the audience, feel free to put it on the chat box and we're glad to answer those as well. So with that, let's go ahead and move these over here and we'll kick off here in just a second. Let me kick into the presentation mode and I hope everybody can see my slides now.
Yes.
Okay, great. So for those who are doing early stage investing, due diligence is a key step in the process and you need to be putting together a process for how you should do that, just so you keep your checklist and keep your process accurate as you go from one deal to the next. And then if you're leading the deal, that's a key thing as well. You got to be able to step up sometimes and lead the deal. You can't always follow, and you need to be ready for that. So, the startup goes through several pages with the investor. There's the pitch presentation where you first see the deal. There's a follow-up meeting where you get more information. And then if it's interesting, you go into due diligence. As an investor, you want to, stay with it and go all the way through to capture all this stuff. Otherwise, you end up skipping steps or what have you, and it can be a problem down the road. So I call this the thorough approach to due diligence. And what you want to do is just cover the main areas that due diligence goes into. And I have 6 of them here on the screen. First, check the market. How big is the market size and how fast is it growing? I often see people talking about the size of the market, but I often don't see them talk about how fast is that growing. Is it growing very fast? And if it's growing very fast, which segments are growing fast? Second is product. What state is the product in? And is this the vitamin or the painkiller? The vitamin makes you better. The painkiller makes a problem go away. You want a painkiller because people will put money down on the table for a painkiller. They might put money down for a vitamin. So look at the product and see at what state is it really in. When I see a software deal up there, I often think, well, there's 15 modules up here. And my question is, how many of those modules are already completed versus they will need to be completed? So you need to get very specific with your questions to understand where you are with it. Next is the legal and IP. Are all the contracts in place for employer agreements and non-disclosures and so forth and non-competes? And had the patents been filed, even if they're provisional, has something actually been submitted is what you want to do. And of course, I always ask the question, what's been submitted? You know, is it a provisional? Is it a utility? Is it a design patent? And when did you submit it? Those are key questions to try to suss out exactly where we are with the intellectual property. And then next is the financials. You know, we want to look at the revenues coming in, and there's a big difference between bookings and billings. Bookings means somebody's placed an order. Billings means you actually have invoiced them and revenue is on its way. And you want to understand those two things very carefully and understand the financials to see if it is what you think it is. And also burn rate is a key factor as well. How much are we burning every month? How soon will we run out of cash? And what's the likelihood of maintaining the cash flow? Next is capitalization. You know, what's the structure that we're using here, and who owns what in the business? It's often the case that the founder owns 95% of all stock and everyone else owns 0.5%. And you in a lopsided case like that, it's possible that the founder will be interested, but everyone else will be leaving because they're not being compensated fairly. And on the other end of the spectrum, we've seen founders with as little as 30% of equity at the seed level. And over time, dilution is going to take that down even lower to the point where will they even continue with the business? So you want to look at the key players and are they compensated to a place where they'll stay there? And finally, the team is one of the biggest ones. People always ask me, where should I spend my time? Well, these areas are interesting to look at, but the team is where you want to spend your time because you want to go and meet the team and understand what exactly are the skills there. Every investment failure I ever had ultimately came back to the team not being up to the task, and they had too many holes that they never were able to fill. So that's a key area to look at as well. So when you want to diligence the market, you know, there's the total available market, there's a serviceable market, and then what I call the beachhead market. Almost everybody has a very large multi-billion-dollar total available market. But what I'm interested in is the beachhead market. Who are the first 20 customers you're going to sell to? And of course, once you use I only need 1% of this billion-dollar market and I have a successful company. And the reason that that's not convincing is the fact that it doesn't tell me where you're going to start. It doesn't tell me that you've already started. It just shows that, you know, there's a market over there somewhere and we're going to start working on it. A beachhead market, what I want to hear is that here are the 20 companies I'm going to go talk to and sell. Oh, by the way, I've already talked to them and they're very interested in what I'm doing, or they want to buy it when I'm ready. So you're looking for an immediate place into the market that you can go that will get people buying into your product. When you diligence the team is the most critical factor. And so of course, you always review the resumes to see what skills they have on paper. And then next, you look for the domain knowledge. How much do they know about that industry? I see many teams who are successful in one business and now they move to a completely different sector, primarily because that sector is growing fast. I see that in healthcare quite a bit. Healthcare is a big market. It's growing fast in many ways, and people come from other industries to it, but they really don't have the domain knowledge. And it's not always about the knowledge as so much as it is about the network and the connections. If you have connections to the providers and the payers and others people in these spaces, you're going to understand it a lot better than if you don't. And finally, you look for completeness. I talked to a company the other day where I talked to 5 people. They were all PhD developers. And I asked the question, who's going to be the CEO? And they looked at each other, and then one person raised their hand, you know, reluctantly. So you really want to have a balance between somebody building it and somebody selling it. So you're looking at the team from that point of view as well. other things that the investors should look at is, what are the risks in the deal? On the surface, due diligence can be a checklist exercise. Just go through and checklist off. They say they have a Delaware C, check. They say they've got an entity, check. But what you're really looking for is the next level down, which is if you can answer this question, you're onto it. Is what do they have to do to be successful in this business? And then what are the risks that could derail them from it? So if you can get to that level, that helps a lot. And then the third level down is what can I do as an investor to help them achieve those critical strategic factors? And so if you can get down to that level, diligence is starting to get to a point where it's viable to make an investment decision. But some of these things you want to go verify that the market size is growing. Like I say, markets often are painted in very large, broad terms, but we may be in a sector that's not growing very fast. Other sectors may be growing faster and may overcome us. Also, when you look at the financial projections, you want to really understand the business. I often find I can learn a lot just from the five-year financial projection, because sometimes I'll see projections that say in year one we'll make $1 million, year two will make $2 million, year three will make $3 million. That's what they call a top-down approach, where we just talk about it from a very high level, when I really want to see a bottoms-up approach where they've actually sold and run a business and they know what things cost and they know what realistically how much revenue will come in after discounts and commissions and other factors that go into it. So you need to dig into financial projections to see how much do they really know about their business, is what I find interesting. And then finally doing diligence on the founding team so that we really understand, are they ready for this task? And if they're missing skills, where are they going to get those skills? And that's often the case with early stage. They've got 3 of the 5 people that they need, the other 2 they're looking for. And so we need to find those 2 before we put money in. So here are some red flags I find in doing diligence on deals. Number 1, founders do not have any money of their own in the deal. It's everyone else's money, or what they call the OPM thing, other people's money. Be very leery of that. 2, the team is incomplete. We're all building it. Nobody is selling it. That's going to be a problem. Number 3, there are no KPIs or operational metrics to review. Key question I ask is CAC to LTV ratio. Some people struggle to answer that question. We should know at some level what the dollar figure might be of both those numbers based on what evidence we've seen so far. Next is the business is set up as the lifestyle business of the CEO. This is going to be typically something where the CEO is going to have a great time, but they're really not going to be growing this business to the high level that it needs to be. And you can tell because they haven't hired the people to help them get there. And next is the cap table is crowded. Sometimes I'll see a seed plus company with 40 investors on it already. Wow, that's a lot of people. And oftentimes that's family and friends, but they have all these 5K investors and others, and it's just a very crowded cap table. Next is the startup has a lack of awareness of the industry. This often happens when they're coming from another industry and is coming together, or it's a new industry and it's emerging, but they really aren't at the front edge of it. They're following along behind, in some cases, very far behind. Next, and this is a big factor, is they have loads of debt. You always look at the balance sheet to see how much debt they have and see what commitments they've made already that we have to go through and work our way around. Next is there's no board of advisors or directors. They're out there by themselves. They're starting a first-time business. This is going to be a problem. They really should get some mentorship, even if it's an informal board of advisors. That goes a long ways to getting to be successful at it. Next, their plans are generic. They don't have any detailed specifics about their go-to-market or sales channel, whatever. It's just generate a lead. But there's 20 different channels that you can use to generate leads. There's different cost structures to those. There's different effectiveness of those. How many of those have they really tried is the question I always ask. Next is the traditional hockey stick, where it's just magically going to jump up for no real good reason. I always encourage entrepreneurs to take those out. It really hurts their credibility when they have those in there. Just carry your growth on as you're doing right now and continue as is. And over time, you'll get to where you need to go. And then the big giveaway on financials is when they don't put the years up there, 2024, 25, 26, they put year 1, year 2, year 3. this always tells me that we probably really haven't even started the business yet. We're waiting for money before we're starting the business. So traction is probably not as good as we hope it's going to be in that case. Next up is if you're leading the deal. One thing we want today is talk about that you need to, separate diligent selected deals and negotiate the valuation with ones you have chosen. So leading the deal often comes down to setting the terms, and the valuation is the big one. You have to really get agreement and buy-in on the valuation itself. If we can't, we can sometimes put liquidation preferences or other tools in there to compensate for that. But fundamentally, we need to be in the same ballpark about valuation before we go into it. And what you'll find is that these deals are rarely done by just one or two investors. They're done by a syndication group of others. And so the terms have to be favorable to the investor to the level that you can attract other people into the deal. It's okay to give someone a great deal, but you have to realize other investors may not be in such a great position to do that. So when you're leading the deal, you're always wondering, how do I get other people to join me with this? So here's, as a deal lead, a checklist of what you might want to look at. First of all, set up a good process for diligence. Make sure you have all the documents, all the data room, everything you need before you kick off. Know the deal economics. I always like to calculate the unit economics. You just get down to, are we really making money here, or are we just trying to make it up on volume? You want to update other investors to let them know how it's going, because at heart later you want to attract other investors to be in the deal. You don't want to be the only one driving this thing. And then if you can see enough of your own investment money to go into it, that really shows commitment. And that sends a strong signal to other investors that there are people committed to this deal. That's the question going through their mind. And then what you want to do is coach the startup on fundraising. Don't just let them go by themselves. Give them introductions, help them hit the right points in the deck, help them update the deck, do things to help them with that. And then you're always trying to move the funding process forward. Doesn't have to be fast, but if it can maintain a steady rate, then it will continue. And then if you have time, join the board of directors. That makes a big difference. And it also sends a good signal to the other investors that you're committed to it. And then just add value where you can. If you don't know anything about sales, don't worry about that. But if you know something about finance, we'll use that as your value add to help them get to the next stage. So after you do your diligence and it's complete and all the questions are answered, you and the team, you have to decide if you're going to invest or not. And so what you want to do is, look to monitor the progress of the company for a couple of months to see if they're continuing to hit their milestones, if they're doing what they say they're going to do. And we're starting to see a growth story form here. We're starting to see momentum and traction take off. But you have to look at it, we don't invest in dots, we invest in lines. So you have to put 3 or 4 of these dots together before you can see a line going through it that is going. So it's important to write it down, what you're seeing, and then go back and look at it after a couple of months, and then you can make an investment decision by that. So it's important to be timely with this as well for the and founder. So those are my comments on there. If anybody has any questions, please put them in the chat box. But that's what I wanted to share today on the how to diligence a deal, what to look for, and then how you might want to lead that deal as well. Let me take this off here. So with that, let's go ahead and move into breakout rooms. I think we have them set up here already. Looking forward to seeing you guys in there. I want to thank everybody for joining us today. I want to thank our 3 presenters. I want to thank Harshal for joining the fireside chat and joining the panel today. Thanks so much, Harshal, for your time and your wisdom there. And then with that, we'll assign everybody to a breakout room. Once you're inside, you can navigate around to others. And at this point, when you're finished with the breakout rooms, we'll be finished for the day. And looking forward to seeing you guys next time. So with that, let's go ahead and jump into the breakout rooms and go forward from there. Have a good one.